Let's continue the gold discussion. Larry Chauvin's Chief Investment Officer at SFG Alternatives. Larry, Happy New Year to you. You're saying that price for the precious metals stuck in a rut. I'm wondering, from your perspective, despite that view, it has risen 7% this year, and what might arrest its further rise?
Well, the problems in Europe, keep in mind, we talk about liquidity, we talk about it all the time, and that's keeping gold from going where it's probably going to go. On the other hand, we're going to see more quantitative easing, backdoor easing from Europe, so that will push gold higher, but it's going to be, again, there's going to be a ceiling with liquidity issues, people selling gold because they have to, not because they want to. But I will say by the end of the year, gold will be higher than it is today.
You've said, though, also there's that physical demand story from China. They won't slow down, will they, even if Europe does inject more stimulus?
No, I don't think China is going to slow down at all. I mean, I think they're in a perfect situation to engineer a soft landing. And as you know, some numbers will be coming out, but their inflation figures are lower. All eyes are looking on the fact that they're going to ease credit. This is going to be good for the commodities space, especially the metals space. So let's just strap on the seatbelts and wait and see what happens.
What would you be buying? What currency that gold's denominated in are you liking the most at the moment?
I happen to like the Australian dollar. I know I'm speaking to my Aussie friends, but the fact of the matter is 101.5, 102, that's pretty cheap given the fact that we're going to see a long sustained rise in commodity prices between now and the end of the year, especially copper, platinum, and gold. You're going to be the recipient of that. 102 seems pretty cheap right now for the Australian dollar.
Tell me about a turning point for the crude price then. As gold pushes higher, what are crude's fortunes like?
You know, we're all going to have to get used to the fact that basically no matter what happens, oil is going to be $100 a barrel and higher. Look at the news that came out today, especially with Nigeria, once again rattling the saber that they're going to cut production. Oil still went down. The fact of the matter is the emerging world is growing. 8 people work, 1 person eats, 1 person eats, 1 person buys a car. The fact of the matter is, oil at $100 a barrel, we're going to have to get used to it. It's probably going to go higher as well.
But what about strategic reserves and the real concern that elevated price is crimping those green shoots that we once referred to as being signs of growth?
Yeah, the strategic reserves are drastically low, both in the United States and in Europe. That is a problem. That's another force that's putting oil higher. But beyond all that, we're thinking of the problems in Iran. What's going in Iran with the nuclear issue? Are they going to close down the Straits of Hormuz? What are we going to do about all this? We have the fact that some of the biggest wells around here are just running out of good sulfur oil. So we have to look for oil. There's plenty of oil out there. It's just more expensive to get.
Copper prices rising. Now, as a barometer of growth, are you seeing that as a lead indicator at the moment? Or you think China is disproportionately occupying the buying action there?
No, I think right now, immediate term, any rise in copper price, especially what we've seen in the last couple of weeks, is really collateral. People in China use that as collateral, and that's really what's affected their inventory levels. Not really strong buying. They have not been chasing prices, and they won't chase prices right now. Yes, scrap inventories are low, bonded warehouses stocks are low, but more than anything, it's been more of a financing tool right now, and I think they're just waiting to see what's going to happen in Europe.
As are we all to round out the week. Larry, thank you so much. Talk soon.